It's great to be with the RFK Compass community again. And as we were mentioning, we're going to be covering software and technology. The two themes that we're going to touch upon are going to be investment strategy and the impact of the COVID pandemic. And then secondly, value creation in software and technology, and does impact matter, right? Are there ESG and impact metrics that are relevant to software and technology investors? And I'm joined by three leaders of three fantastic firms that I know really well. And maybe what I'll do is just ask them to briefly introduce themselves and their firms. And why don't we kick it off with Bedad, Devin, and then Giro.
Sure. Thank you, David, and thank you, RFK, for including us today. Obviously, very different this year. Last year on Zoom as opposed to in person with you all, but great to be here. Great to engage in this discussion. Bedad Iqbali, founding partner, managing partner, Clear Lake Capital. We really invest in two core sectors: technology, software, and verticals within industrials. Have been fortunate to have many of you as partners, whether in deals, as LPs. We take very much a sector approach, but have capability to go up and down the capital structure, look at value, look at growth deals, and really have flexibility of entry points, and been fortunate to build the firm over the past 15 years.
Thanks, Bedad. Bedad and I have had a pleasure of working on a lot of deals together and spend time with HG. And David, thanks, and Sansia, thanks. Devin Parekh, Managing Director at Insight Partners. We are a growth equity investor based that does software and internet only, but we do it on a global basis. We actually celebrated our 25th anniversary last year via Zoom. We were supposed to do it not via Zoom, but it ended up being via Zoom. For us, we do everything from kind of a late Series A growth round, which can be as small as $15 or $20 million, all the way up to kind of a go private transaction. A recent transaction was $6 billion. So we'll do an equity commitment as small as $15 or $20 million, all the way up to $1 billion. I would say one of the things that differentiates us is we have a 70-person team, which is actually the largest team at Insight, which actually focuses on kind of operational value add. We can talk more about that later. And I'm just really happy to be part of this group.
Excellent. Well, these two gentlemen certainly are a tough act to follow, but thank you for including HG. Thank you for including myself. I'm Gero Wittemann. I'm a partner with HG. HG is a leading European software investor, and my function within the firm as a partner is to co-lead the relatively nascent North American effort, which is just under 2 years old, but it's been a lot of fun to build a firm within a firm. We are a franchise that focuses primarily on software. We do a little bit in data, and we do a little bit in tech-enabled services. But I think the way in which we differentiate is that we try to build businesses that change the way in which we all do business. And I'll be delighted to get into that a little bit more. It has to do a lot with what we're going to touch on later. The core to that is so much of the impact, whether that's in software or elsewhere, but maybe especially in our sector, is people, human capital, doing things the right way. And that's what we want to stand for.
Great. Thanks, gentlemen. I think the first question that I have, and maybe we can kick it off with Devin and Bedad, is, as an LP and many of us on our side of the LP-GP relationship, we've been hearing for the past 12 months or so that the COVID pandemic has accelerated trends that already existed before COVID, hit the world. Can you just walk us through your experience in your portfolios and your pipelines, and just sort of take us to maybe the second level bullet of what that really means?
I'll jump in on this one first. First of all, I'm not sure. I can tell you for sure we didn't predict exactly what was going to happen. We did a COVID update at the end of March with our LPs, and I think the message I gave was I'd expect that we're not going to make a lot of investments this year. that this is going to be probably the toughest operating performance we're going to have. And you should expect that your marks are going to decline significantly over the next 12 months. That was my prediction in March. I was 0 for 3 on those. I think one of the things that I think we always believed that software was a very resilient market, but I think we probably underestimated its resilience, to be honest with you. I mean, I think all the things that we expected and a lot of research analysts and frankly our CEOs expected just really didn't come to pass, because what really happened was it turns out that software was so important to kind of running your business, and as you went to a remote environment, it became even more important. And so you had two separate things that I think happened. One you talked about, David, is that you had trends accelerate. So like I'll use the example of all of a sudden nobody could go shopping, and so obviously you saw a massive increase in adoption of e-commerce. But with the massive increase in adoption of e-commerce, which we're also investors in, is also a significant investment in software infrastructure that needs to get made by those companies, particularly offline retailers, to be able to offer a more competitive offering relative to the Amazons of the world. So you had 5 to 10 years of e-commerce adoption that happened in 2 quarters, and companies like Walmart and others were able to make billions of dollars of CapEx investments that they otherwise would have spread out over 4 or 5 years in a really short period of time, and really have the street not only not have a problem with it, but encourage it. And so you had very, very strong kind of IT investments. You had that, and on the other side you had just look at how we're all meeting right now. Collaboration software. I think we're using Hopin, which we're not investors in, but we're using a software platform that we're using StreamYard. All of these technologies, which we're seeing good adoption rates, the adoption rates have massively accelerated. I could go through another 5 categories, but so what we actually saw is that we didn't really see much of a drop in retention rates. We did see some decrease in growth rate, right? But to be honest with you, a decrease in growth rate is not what I was expecting in some of our companies. Actually, as I was actually expecting to see absolute declines. And we only saw absolute declines in very, very few categories. And those few categories were ones where the end market was really radically impacted, right? So you take restaurants, you take travel. You had some markets where they literally went to zero ticketing, where events went away. So it was a relatively small amount of markets where the end market demand evaporated. And in that case, even the software, the platforms that enabled those had significant softening in demand. But in almost every other place, that didn't actually come to pass.
Yeah, no, similarly, I agree with Devin. We had our LP update first week of April last year, I think. And similarly, it was an uncertain world. I think, turns out we've really had, one of the best years, right, across the industry in terms of portfolio performance, investments. To Devin's point, really 5 to 10 years of acceleration and a move to digital of workflows. Devin had 2 great examples. Retail, how has been impacted. I'll give you 2 more. Mobility and security. All of a sudden, we have to go to a complete mobile environment. 2-factor authentication, et cetera, has become front and center. In terms of identity, identity and digital identity, all of a sudden becoming almost core foundational. Healthcare IT, how we deliver and monitor healthcare, right? We'll talk about it more, but an incredibly inefficient process that's probably accelerated 5 years. Again, similarly to, I think, both Inside and HG, we've seen, a portfolio that's performing remarkably well. I would say we've been lucky in that we weren't invested in some of the, consumer front-ending, travel, gym, hospitality sectors. We tend to, play in sectors that are more B2B, more defensive. So I think we're fortunate where, I think we had an opportunity to really, play offense, frankly, with new investments. We, given our strategy, we pivoted to making rescue financings and credit investments. We deployed about $3.5 billion of equity capital in the first 60 days of the pandemic, maybe another $4 billion since that time. So we've been able to go in overdrive mode. And again, to Devin's point, a lot of the operating best practices, reporting, monitoring, things we put in place in the portfolio had a chance to show. And we did go into, evaluation of cash management and what an outlook looks like, stress testing a portfolio if bookings was down and if cancellations and renewals were down. So I think we did a lot of that. We had the chance to put a lot of the crisis muscle memory of what do you do in a portfolio to work. I think, by the way, we've all been lucky. We're investing in a good space that's accelerated in terms of digital adoption. I would be remiss not to frankly give some credit to the policymakers, and we don't do enough of that, frankly, to the Fed Reserve, right? I think there's a lot of good policy that helped us be in a different place, frankly. And if that wasn't implemented again, I think I think the macro, the Fed reaction here really helped stabilize the market. And again, I think we benefited from fast adoption, but it's been a good year largely because I would say a global response to obviously what was a pandemic none of us have experienced, hopefully won't experience ever again.
Yeah, and picking up on something Devin referenced, right? Like there were some end markets disproportionately impacted by the pandemic: restaurants, live events, ticketing, travel. One of the things, and Giro, I'll ask you the question. We often heard about, or when we look at investments in technology, growth equity and buyout firms, like the mission critical nature of solutions. Like, has the pandemic stress tested like what is really mission critical? And have you seen kind of winners and losers in that kind of software technology solutions market? Because I think it's easy to be mission critical when you've got healthy operating budgets or CapEx. But in the past 12 months, I would suspect that really tested, some enterprises.
Yeah, I think it's an interesting question. And I think I'd like to acknowledge first that it really has been a tremendous tragedy and a terrible situation overall. And fortunately, some software businesses have been able to be truly mission critical, i.e. helped improve the situation. And I'm thinking companies that would have helped nurse staffing. We happen to be invested in one in the UK that really worked in overdrive with extra shifts using the software to make sure that the hospital's frontline responders were adequately staffed to help supply chain. Some companies that made it possible when everyone was clamoring for toilet paper. I remember that actually the shelves were somewhat filled. So to me, there's an aspect of that truly mission critical and mission critical for all of us. Beyond that, I think I would say, thankfully, the mission criticality that we've all hung our hat at has held. I'll quote some numbers from our portfolio. So revenues up in aggregate about 22%, some operating leverage on top of that. I think there's a bifurcation that's important to point out. Devin referenced one, which is end market. Very difficult to predict how something would respond to in a pandemic, because quite frankly, no one had that on the list for the past year. And so even some sectors that looked very solid got tested in ways that no one anticipated. The other thing I would point out, and I think that's an interesting one to bear in mind, is the legacy revenue model of selling big license deals is probably something that really saw a big slowdown in the past year. Subscription models have continued to do fairly well. And there, maybe I'll quote the numbers from SAP, where their license maintenance has decreased by 18%, whereas their cloud business is up by 24%. So those are some of the puts and takes. Not everything predictable, but thankfully overall software is still an important critical part and has hung in there.
Yeah. And so, given the resilience of software and tech enabled, and historically as a sub-strategy of private equity, the strength of the returns that your funds and other technology and software funds have delivered to their investors, let's have a quick discussion about growth equity, structured equity versus control buyouts. Is there a better approach to the opportunity set? Because we have those strategies represented on this panel. And then maybe I'll turn to Devin to sort of kind of hear the case or the rationale for growth equity investing.
Yeah, David, I'll start by saying that we actually have all of those within our kind of portfolio of things that we do. So, we do buyouts. We obviously do a lot of growth equity. That's probably the bulk of our dollars. And we actually now have a structured equity fund as well. So we kind of have a full continuum. And I think the way I just think about it is it's certainly, I think you, like in any asset class, you think about it from a risk return kind of standpoint. A growth equity deal that might have extraordinarily high growth might not yet be profitable, though we have ones with extraordinarily high growth that are profitable. Many are not. You might expect to earn a higher rate of return than a company with a 40% cash flow margin that's growing very consistently at kind of 15% with really high net retention. And you might expect an even higher return if the company only has 4 or 5 customers and you're doing a growth equity deal at a Series B type stage. So I think we just think about it as kind of, different rates of risk and return. I will tell you, in the environment that we're in today, frankly, the buyouts have a hard time stacking up against growth equity. The growth equity returns are just significantly higher, than buyout returns. Largely because I think we're in a market that is really valuing growth extremely well. And so growth assets has seen multiple expansion that's even north of the multiple expansion that we've seen in buyouts, which has been considerable, but it isn't the same as what we've seen in kind of growth equity. And then that separate asset class, the kind of structured equity, which we just raised a fund in recently. I think we are looking there. We have to think slightly differently. We're very downside. You have to think much more about your downside protection. And while we don't like to do deals with capped returns, you're generally in a structured deal protecting your downside and kind of often paying a price where your upside return is going to be more muted than you would in a buyout transaction or a growth equity transaction. So they're just different risk return buckets is kind of how we think about it.
No, listen, we agree with that, David. And again, I think to add to Devin's toolkit and set of mousetraps, we do buyouts, we do defensive growth. Although I would say later stage companies, we have also a structured equity product and a fund, and we do a lot in special situations. And you ask, there hasn't been much special situations in tech and businesses that go through stress. I would tell you, 50% plus of the leveraged loan market and leveraged finance market is technology. Your average tech company with a PIK holdco is getting levered at 9+ times. We did have a window, albeit 60 days, where we bought a significant amount of credit investing and rescue financings and things that are private equity, top quartile private equity returns. So for us, it's important to have 4 or 5 tools in the toolkit. Depending on the market, depending on a cycle, I think it's important to know what you're good at. I would say we've partnered well with Devin and Insight. We think they're tremendously differentiated in ability to do early stage and bring some of the early stage capability to the buyouts. HG obviously has a deep expertise and I think a leading franchise in Europe. Again, great partner. So I think what we do well is really, to Devin's point, underwrite risk and price risk and pivot between core buyouts, more defensive growth buyouts, structured equity. Devin and I have done 2-3 structured equity deals that'll be 2.5, 3, 4x returns, right? It doesn't have to be capped upside, but you can't really have that be as your only tool in the toolkit. And again, I think, Clearlake, I think we're, differentiated, frankly, in our ability to understand capital structure by different parts of the capital structure. And I do think in an environment where your average software company is trading at 20 times, levered at 9 times, you are going to have businesses that, will run into issues, will run into, frankly, over leverage. And I think having the tool in the toolkit is going to help us, bring to bear. And again, I think agility, flexibility, but having tools that you have used before, have confidence in is frankly new paradigm. And I think the average, I just do buyouts in tech, and call me later, if it's not a 100% deal. I don't think that applies anymore. The industry's evolved. I do think that the larger players, frankly, in the pandemic, some of the mega cap funds got stronger. They had more tools in the toolkits. They could react faster. They had permanent capital. They had different pockets of capital to bring to bear for different circumstances. So I do think core skill set is critical. I think Devin mentioned the inside onside team. We have an OPS group. Having operating capabilities is critical. There's, as I've shared, David, in your diligence sessions, there's nothing as proprietary. Any GPU says we only do proprietary deals. I beg to differ. I think there's a lot of capital. There's a lot of competition for transactions. You gotta make what you bought better, and I think having the operating capability is critical and differentiated, and we all have it in different ways. And you got to make what you buy better ultimately in what is a later stage, more mature alternative assets class in private equity, and certainly software private equity.
Yeah, and so just to ask a question, if valuations in your space, software and tech enabled, are sort of 18 to 20 times, right? That would cause some investment committees, just to paint a picture of a traditional buyout shop that does, industrials and business services, maybe they do energy at some point, and then they look at where you guys invest and they see the valuations, they'd fall out of their chair, I would think, and have a lot of heartburn trying to get comfortable. So let me ask you, the three of you, this question, and Giro, maybe I'll ask you, can you find value in software and tech, or is value, it's not 8 times EBITDA, it may be 18 times with an incredible 5-year plan, for growth. So is value sort of different in your space compared to kind of traditional buyouts?
Well, so David, since it's all we do, I'd love to say that we do find value for our investors in that space. I think the thing I would say, and I'm sure you're doing it, as are probably many of you in the conference, I would compare all multiples on a cash flow basis, because I think that helps adjust some of the pure EBITDA advantage that you might see in other sectors that are then heavily burdened after EBITDA. I think the importance in tech and the way in which we go about it is really software is just a tool, and it's there to solve a problem. So you have to really deeply understand the end market and the importance of that problem and how well or unique the software is in addressing it. And if that is the case, then there is quite an opportunity for relatively significant growth and often multiple avenues for value creation through all the operational initiatives, operations teams that have been mentioned by my co-panelists. So I think as a result of that, you can find hidden gems. It might not always present itself at the outset, but through relatively rapidly deployed measures, you can find yourself into value. Sure.
And Giro, maybe I'll stick with you just to ask a question, since you're leading HG's efforts in North America, and as your panelists have referenced, HG is a well-established leading software tech-enabled investor in Europe. Maybe speak to us about the differences between the European market and the North American market as you source deals, and what your experience has been so far after starting HG's efforts.
Yeah, so thank you, David. It's been a really fun ride. We've been at it for about 2 years. We built out a team of 12 investment professionals, and we've been able to build our portfolio of now 9 companies in that time frame. So we've certainly been very active. I am European, so I get to say some things about Europeans that maybe others can't. It's interesting that in Europe, the overall investment in software as measured as a percentage of GDP is lower than it is in the US. It might not sound like much, but it's probably 2% versus 3%. And within Europe, you would find that further north you go, the more technologically sophisticated. For example, and it's a sector that we're well versed in, sort of tax software. In Norway, no matter how complicated your personal tax situation is, you can file your tax return online in less than an hour. The further south you go, the less software adoption you see. And then I think the other phenomenon, and I'll stick with the same market, this tax market, is if you think about SMB tax and accounting software in the US, it's really Intuit QuickBooks. So you think about that as a single 110 billion investment opportunity out of reach for PE. And in Europe, there are a lot of companies that would touch it: Visma, Iris, Sage, Cegid, Team System, et cetera. So there's some element of riches. To the other degree, though, there are national barriers that prevent rapid growth, regulatory differences. So in some instances, it's easier to find buyout targets in the US. The market has a greater velocity and more targets. And so often in Europe, what you find is fewer targets that are better signaled, and a lot of the usual suspects focus on them. Whereas in the US, it's very, very critical, and I'm sure my co-panelists here can attest to that, to pick the ones where you really have an axe to grind, a point of view, and to be really aggressive when you found something that you really like.
Yep. And maybe on the, like, you know, sort of, that's sort of pointing us in the direction of the competitive landscape, right? And I think from an LP perspective, like software and technology, you know, has demonstrated that in private equity, I think it's probably the best performing sub-strategy. And I mean, I remember being a first-year associate at Merrill Lynch in investment banking when Silver Lake was raising Fund 1. And I think they were raising $1 billion in like the year 2000 in the midst of the dot-com days. And I remember, you know, there's always chatter like, wow, like technology and buyouts, like, how does that make sense? And that's completely proven out over 20 years. So obviously, a number of generalists and the global asset managers with private equity strategies have entered the space over that time period. And maybe I'll ask Devin and Badad to speak to that. Like, how do you see the competitive landscape? Is it a positive thing to have that kind of more competition and new entrants, you know, or does that, you know, kind of make it even harder to, you know, to close deals and, you know, add valuations that you can get through your investment committee?
Look, I mean, I think there's obviously, well, I think there's positives and negatives. I'll start with the negatives, which is, look, David, I think I'm the only one on the panel you're not an investor in. So if I were trying to get you to invest in our next fund, and I said, by the way, 25% of our next fund is going to be retail, I'd expect you to turn me down. But for whatever reason, if you're a retail investor and you say 25% of my investments are going to be software, you don't get turned down. And so I think that we are seeing a lot of generalists come into the market, and we are. I used to be that I was losing deals mostly to people on this panel or a few other firms, and increasingly I'm losing to people who I've never lost to before. Right now, that could be because I'm not seeing it, or maybe they're not seeing it right, and you know, that time will only tell whether that's right. But my guess is I'm much more likely to mess up a retail deal than a software deal. And so I think that there is new competition that's coming to the market that's disrupting the market in ways that aren't necessarily healthy. The flip side of that is when we're selling an asset, we also have a much, much bigger universe of buyers for those assets. You know, it used to be if you're trying to sell $1 billion North software business, you know, you had 5, 6, 7 people that you could credibly have a conversation with. I was in a process recently where I think they had 18 or 20, you know, first round bids. And that's just the people who bid. That wasn't all the people who got the book. So I think that you have a more robust exit environment because of that. But there's no question in my mind that when you have the increased level of competition, it's going to put pressure on returns.
Yeah, no, I agree with that. I think there's probably 20 to 25 either sector-focused pure play firms like an Insight or folks like us who are software is 50, 60, 70% of the investing business. I think you got to differentiate, to Devin's point. There's many new entrants, by the way, industrial firms who've hired one or two people. We're in software. I think we do tend to lose to those folks as well. Candidly, we can't also underestimate the appetite and interest from LPs, and LPs allocating co-invest dollars to software, to tech, frankly, doing it directly, doing it in a manner where they've driven small firms to write much larger checks, underwrite perhaps lower returns because of the gross to net spread. So that can't be underestimated. And again, we do think, frankly, a lot of the co-invest has driven some of the behavior. I would say a couple more points. One, we don't actually think of our industrial verticals as separate and apart. We do think software and tech is impacting many industries beyond the obvious ones. We own one of our larger industrial businesses, a business called Unifrax, that does thermal management for batteries. Their hottest, most interesting breakout area is an EV battery, EV technology, which again, when we bought it at 11 times, it was an old industrial businesses, but it's got to innovate, right? So we do have a lens where our packaging companies or our industrial businesses have to have an ability to innovate. We do think software may not be in the world, but it is changing a lot of workflows, industries. I can't think of a sector, whether it's home building, construction, logistics, retail, healthcare, automotive, that's not impacted by technology. So we do think the TAM is increasing in a good way. We do think it's accelerated. Lastly, to come back to the last question, EBITDA multiple as a measure of value is I think misleading. Is one of the metrics. It's not the only metric. We've done both. We've paid 20 times. We've paid 11, 12 times for carve outs. My big question is really the point Hiro raised of what are you going to do with it? We've done 35 add-ons the past 3 years, each year in the portfolio. Can you make what you bought better in terms of operating efficiency? Cost, we'll get into in a bit, is one measure of growth, but top line revenue growth, in our view, is equally, if not more important, and then cost actions. So I think you do have to have a perspective on, making what you bought better. And again, I joke with investment committee that we all keep quoting EBITDA multiples, but there's many things, cap software, capex. Maybe it's okay to pay 18 times for a software business that's 100 times recurring, that has no capex, versus an industrial business, equipment rental business that has 80% of its cash flow invested back into equipment rental, doesn't really generate free cash flow, right? So I do think it's no question the metrics and values have gone up, and most investors, institutional, public investors, pension funds, et cetera, have gotten the joke of the resilience of the secular long-term growth of the sector, and valuations are up, and we got to be that much better, that much smarter, that much more impactful on the operations of the business. But we still think we're in the early days of that, long-term, third, I guess, revolution, info revolution, and we're still probably in the fourth and fifth inning of it, as opposed to the ninth, and we still think it's a great place to be.
That's great. And then maybe now we've received a handful of questions from the audience, and I'll take one of them to read to the panelists. And the question is, have any of you been thinking about the human rights and data privacy rights that might come under fire with the rapid shift and dependency on technology solutions? It's great to use this technology, but if used without thinking about the problems associated with it, it could possibly lead to the cause or other human rights violations. So I'll just open that up to the panelists.
Yeah, I think that there's a number of considerations as it relates to issues like that. One is as it relates to privacy. I think you're seeing that played out on social networks as an example, but you're also seeing that played out in almost every application which has a lot of data. So kind of who owns that data? And there's a lot of evolving. Well, there's been a legislation in Europe around that. I think you're going to see more legislation in the US around it. So the companies are going to have to be more mindful about how they do that. As it relates to human rights, and I'm not sure human rights is the right word, but take AI as an example. and you think about using AI in an HR application, a hiring application, and it's being used across every example. But if you went to Goldman Sachs and said, we're going to use and I'm not picking on Goldman Sachs. You could say this about Insight. You could say this about any of the firms probably. We want to look at your last 20 years of partners, look at that data to see who's been successful, and then use that data to determine who we're going to hire today. Well, you're probably not going to end up with a really diverse class because 20 years ago and there wasn't a lot of diversity, right? So I don't mean to say it's a human rights issue, but it's an issue around we really need to be sensitive about the implications of some of the technology we're using and the impact that it can have, on society. And I think some of those things will happen through regulatory frameworks, but others, I think we as users of technology are going to need to be more sensitive on how they're used.
Great. And we just got another question, and this one's one about referencing an earlier panel today where there was a discussion about equity and access to software, especially in healthcare and education. Could the panelists share how they're dialoguing with their existing portfolio companies about this topic? And within your firm, what have you observed in terms of offering solutions to underserved communities? And maybe I'll ask Giro to address this. And I'll just share we've definitely seen the socioeconomic disparities during this pandemic, both in healthcare, education, as well as the workplace, right? I think, the four of us and our colleagues, we've been fortunate to be able to use this technology to continue to invest in companies, to invest in funds, to monitor our portfolios. But there are other workers in other industries where technology isn't as much of a factor, and they've been impacted more seriously than we have. But Hiro, maybe you can share your perspective on this.
Yeah, I think it's a really important topic and one that we take very seriously. And we actually have set up a foundation where we as a partnership take some of our profit and we try to support causes that improve the world a little bit, but we try to leverage what we do in our investing business. And one of the things that we've really honed in on is exactly this, because there is a gap, for example, in tech companies around how many people make it as software developers or coders, and minority backgrounds are severely underrepresented. So we've partnered with an organization called SEO, and SEO sees every opportunity, a company that's successfully helped people get into banking, into private equity. And we think there's a real opportunity to help these people get into tech as well. Very talented young people that, if given the opportunity, can excel. And it's really, I think, a very important thing that we all take very seriously.
Great. And maybe one final question before we try to wrap up. You each have your own approach to operating performance and driving value creation. And unfortunately, we haven't had a time to get into the detail. There's Insight Onsite, there's OPS, there's the portfolio team and operating partners at HG. But maybe you could each speak to, do you think about impact and ESG considerations? Are there metrics that you use at your portfolio companies because you're tracking them, or because the strategic buyers, when you exit, care about those types of metrics? Have you maybe whoever wants to jump in, please feel free.
Yeah, I think I'm a big believer in what you measure, you impact. What you don't measure, you don't impact. I would say that the biggest push, certainly over the last year for us, has been is tracking around diversity. In our portfolio companies, we could do a whole panel. We've got 20 different initiatives that we're working on around this topic at Insight. In fact, they're on our website, so we made them public. And part of the reason we made them public is to make ourselves accountable, because we want people to come back and say, including LPs, you said all these things on your website. Where are you on them? And one of the reasons we did that is because and our employees, frankly. But I think what we're doing with the portfolio is, for example, I was at a board meeting, just the other day, and I said, I asked them, I see your turnover stats, but do we have diversity stats and turnover? And they said, well, we've just started tracking it, so we're not really, we don't feel like we're tracking the information correctly. I said, I won't worry about whether you're tracking correctly, just start reporting it. And we'll improve the reporting over time, but it's important that the company realizes this is something the board is focused on, and we're going to look at it at every board meeting. And so I think in that ESG space, and the other thing I'd say is Badad and I are co-investors in a company called Diligent, which is a leading kind of board governance portal. But we as a company are doing a lot around this topic, particularly around board diversity, and really trying to increase the amount of minority representation on both public and private company boards. And we've had a number of private equity firms, including Clear Lake and us, commit to adding a set number of underrepresented minorities on our boards over the course of the next year. So I think there's a lot of things that we can do. I think my biggest thing that I tell people internally and try to tell our portfolio is everybody thinks, what can I do? And I always do something, because if you do one small thing, a lot of people doing one small thing, it actually ends up being a big thing.
Yeah, no, I agree with that. And again, Giro started this by saying, we've all done well. Knowledge workers have done well. Private equity's done well, but it has been a tragedy. It's compounded, by a lot of things. And you're highlighting a lot of the, education gaps, access to healthcare and outcomes gap in terms of frankly mortality rates amongst different subgroups. So I do think technology and frankly what we all do in terms of long-term portfolio planning and approach to governance and matters. You asked David a specific question: do the strategic buyers care? I think frankly today my guess is it's not the number one or two item on their list of are they going to buy the asset or pay a premium price because of it. But if we're building businesses for the next 15, 20 years, we do think it matters. We do think it's strategic. To Devin's point, Diligent is doing great and leading really an industry effort now. I think there's more than a dozen private equity firms, I think close to 20, 25 who made that commitment, and we're talking to more every day. I think the objective is not to make that a league table credit, but make that the standard. I think we could do a lot across the, frankly, portfolio company management beyond just the boards in terms of providing opportunity. Giro mentioned SEO, and Twigo, they're doing great work in getting access to people at a young age to an exposure to finance, to private equity. We think it's critical. We think by the time you're at 10 years into your professional career, if you haven't had exposure, it's too late. It's got to start, frankly, at the K through 12 level. It's got to start with exposure in college and certainly pre-business school. So I think really a sustained effort that I think a lot of people have made will make a difference. I think difference, to Devin's point, you got to start tracking it, but hopefully we see results in measured in years and over a decade as opposed to over months. But as long as the industry's committed to it, I do think, and I think there's a genuine commitment as opposed to a PowerPoint commitment to it that maybe we saw 10 years ago. So I'm optimistic, but it's an evolution and it's a process, and it starts with a lot of the core foundational areas: education, healthcare, and access, frankly, and exposure being the, in my view, the primary areas to improve on.
Absolutely. And then look, in the balance of time that we have, I'm going to fire off a series of rapid fire questions to the panelists to get your quick one-line answers, and hopefully the audience can glean some insights from your perspectives. And why don't we go in the order of Badad, Devin, and then Giro. So the first question is, once the COVID vaccine is broadly distributed, do you expect a snapback or a more gradual approach in a return to normalcy for our industry and society generally? So we'll start with Badad.
Yeah, I think it's going to be a gradual return to normalcy. We've had, a year plus long social experiment in distancing. We do think, having a normal workplace, vaccinated workplace is important. We're not going to mandate it, but we hope more people, take the vaccine, and, likely a gradual return to normalcy over months and quarters, probably not years, but it's not weeks.
Devin?
I would have said more of a snapback, but I define snapback in this case as a couple of quarters.
Yeah.
Not a couple weeks, but I think it's going to be relatively quickly. I think there's a lot of pent up demand for people wanting to do the things that they've been not doing for the last year.
Well, then I'll play the economist, and I'll say it all depends. Some sectors have pent up demand or have been depressed. I think that's more rapid, and then the broader economy probably more gradual. That's my view.
And then, given all of your experience in software, could you identify one or two industries that have the most opportunity still to embrace technology and software?
Healthcare, I think. Healthcare IT, whether it's on the cost side, whether it's on service and patient and outcome delivery side, it's still, it was in the dark ages, it's now maybe in the middle ages of cost and outcomes and delivering better healthcare.
I was actually had the same answer, but I was going to just add a little bit to it, which is that I think the other thing, we talked about e-commerce earlier, but if you looked at what happened with healthcare, you had this massive transformation on digital health. The regulatory environment on being able to do remote appointments totally changed. So the way care, I think, is going to get delivered, including mental health care, lots of different types of care, which have been hard to access. This digital transformation is going to radically open up access to care for lots of people that didn't have access to it before. So I think it's going to create a huge economic opportunity, but it's going to also have huge societal benefit.
And I think wherever there are problems, technology can help be part of the solution. So I think we've touched on healthcare, we've touched on education earlier, where there are still surprising manual processes and friction losses that occur. I think that's the sweet spot, and wherever you look, there's opportunity for technology.
And then we kick this panel off with the observation that there's been an acceleration of existing trends. Let's say we have the distribution of the vaccine, and there's whether it's a snapback or a gradual return to normalcy. Once we get there, what's the impact on this acceleration of trends in software and investment in software? Do you expect a plateau or a deceleration, or has there been kind of a flywheel effect over the past 12 months where it just continues in that trajectory? Badad?
Yeah, I think Jiro made the point earlier, right? Subscription, and transition from license to subscriptions mattered. These are critical workflows and business, processes that have transitioned to it. I think it's gonna, listen, we may have seen some acceleration of pull forward of demand in going to that digital workplace, and I think you're going to see continued sustained growth. Obviously, maybe not 22% a year and accelerating, but I think you are going to see a long-term secular shift. Obviously, sector and subsector and company dependent, but we do think it sustains.
Yeah, I think this is a flywheel with the caveat that there's certain. Is Zoom going to grow as strong as it did over the last 18 months or the next 18 months? Probably not, but it'll still continue to grow. And so I think there's a flywheel effect, because I also think that, notwithstanding my snapback comment earlier, I do think everybody on this call will probably do less in-person board meetings over the next 2 years than they did over the prior 2 years. So this collaboration, the types of tools that we're going to use to collaborate, I think that flywheel effect is going to be in place for a while.
And then I think I would just quote a few CEOs. So the Intuit CEO said, "We're never going back. We've leapt ahead 5 years." Satya Nadella at Microsoft said 2 years of digital transformation in 2 months. And Sabre, the travel platform, has basically re-engineered 2,500 servers of on-prem legacy on the Google Cloud. So those are just advancements, I think, and comments that illustrate that same point. It's a flywheel, and we're not turning back.
Great. And then another question, it's sort of a crystal ball question again. Do you expect to see a software-focused impact fund And if your answer is yes, in how many years' time do you think the market will see that?
Yeah, I think many of the impact funds are investing in technology and digital media, data, software. So again, we think of software technology permeating many sectors. So I think it's already happening.
Yeah, I think the same. I think just like you've got generalists who are now taking their portfolio to 30 or 40% tech, impact funds are going to do the same thing. I'm not necessarily sure that you're going to see a software only impact fund, but I think you're going to see a lot of impact funds have a tremendous exposure to technology and software.
And my point would be, I think it was Bedard who made the point earlier. We've got to make these companies better. That's our responsibility, and that's how we succeed. Quite frankly, both ESG and impact are a part of that. And so across our portfolio, in two cases, in a compliance and quality software business, as well as a platform that does charitable donations, we've got impact funds as co-investors and partners, and they're bringing expertise to the table. So it's the same rationale as partnering that we would employ in other areas. So it's already visible, David, I would say.
Yeah, and then the final question, just to wrap us all up, invoking my memories of watching Field of Dreams and If You Build It, They Will Come, as senior folks at three great GPs, when do you predict you'll have your first in-person annual meeting? Do you think it's going to be 2021, 22, 23? What are your thoughts?
Likely 22. I think annual meetings, events are ultimately a social event, and I think there's different degrees of bounce back, geography, companies, LPs, GPs, so I think 22, and I think it'll dovetail with the RFK conference in person.
Definitely 22.
I'd echo that second.
Excellent. Well, I'd love to thank our three panelists for sharing their insights and observations with us. I'm personally looking forward to hopefully joining all three of you at your next in-person annual meeting. And thank you to RFK Human Rights, RFK Compass, and back over to you, Sansia.